Hello, M&A scientists. Welcome to the M&A Science Podcast. I'm your host, Kison Patel, CEO and founder of M&A Science. Joining me today is Andrey Galiuk, Vice President, Corporate Development and Investor Relations at Dover Corporation. Dover Corporation is a diversified global manufacturer that delivers innovative equipment and components, consumable supplies, aftermarket parts, software and digital solutions, and support services, traded on NYSE under DOV. Today we're going to talk about performing strategic diligence in M&A. Andrey, how are you doing today?
Doing very well. Thank you. How are you?
We're here live at Dover Corporation. Is this headquarters for Dover?
Yes. Thanks for coming. Yeah.
Based in, I'm right outside of Chicago in Downers Grove.
Yes.
That's the thing I like to do. Usually most people have the studio and then you got to go there, but I'll come to you and I get fun. I get to check out all these global headquarters.
Yeah. Dover was actually based in New York City until 2010. And then they moved to the industrial heartland of America.
Was that why? Just to be closer to the industrial scene?
Part of the reason. It was before my time, but I think that was part of the reason. Kind of, being an industrial manufacturer headquartered in New York is fell out of fashion at some point.
Can we kick things off a little bit about your background?
Yeah, sure. I'll reach kind of far back just to give you the building blocks of my background. So first of all, my accent, everybody will notice I'm originally from Ukraine. That's where I grew up. I did a couple of years of investment banking there before coming here to do my MBA in Chicago. And then I met my wife while at school, and one thing led to another, and now I'm in the suburbs of Chicago. Post-MBA, I've done over 7 years with BCG. I was a management consultant. And my specialty was corporate development functionally, and industry-wise it was industrial goods, which made later Dover is a very natural landing spot for me when I decided to transition out of consulting into industry. I joined Dover in 2017, almost 7 years ago, as a head of M&A, and over time I picked up a few other kind of roles and functions. So I oversee our strategic planning process and corporate strategy, and also investor relations. We're a publicly traded company. Now I will caveat that I'm here in private capacity, so I'm not representing Dover. I think it's important to mention.
Absolutely. I think we actually put that in the podcast at the end, a little legal disclaimer, but all the opinions are here. It's just Andrey's, no reflection of any companies you might be associated with. 2017, 7 years is a long time. And Dover's pretty acquisitive. How many deals have you seen in that time?
Dozens. I don't remember the exact count. In our investor materials, there's always a slide. I jokingly call it my resume slide because it shows all the deals we've done cumulatively over the past 5-6 years. Yes, I mean, just a little bit of history. Dover was built through M&A. So in the 50s, a group of investors pooled some money. They bought several good manufacturing businesses, and some of them are still in the portfolio. And then they took the company public, and then they used cash that those businesses generated to buy more good businesses over time.
Oh, wow.
And so it's over this 65-year history, hundreds of acquisitions, divestitures too. So it's an active portfolio management business, and it continues to be central to the strategy, to the story. That's kind of part of the value proposition to investors.
It's an investment company.
To a large extent. I mean, interesting that you mention it. Capital allocation, right? It's a very important skill of a CEO, portfolio manager, and somewhat overlooked, arguably. Just to quantify it a little bit, if you think about, I'll use public company as an example, right? But if you look at average cash flow yield, which is just free cash flow that the company produces per year divided by market capitalization, right, is 4 to 6%. The last I looked was S&P 500. It's changing, obviously, with the valuation levels. But so think, if you are a CEO entrusted with a business, and then your tenure is, let's say, 10 years, you are making decisions about reinvesting, that 4 to 6% of free cash flow times 10 over half of the market capitalization of the business. Now, free cash flow after CapEx, right? So if you add back CapEx, you're probably somewhere 7, 8, 9, up to 10% cash yield. So in 10 years, you're basically redeploying the whole value of the business in some form of fashion, either organically, giving it back to shareholders, or investing in M&A. So M&A is obviously just one of the options you have as a capital allocator. And just I think that magnitude just makes this capital allocation a very important skill. And that's why being strategic about it and thoughtful is so important for success in the end.
I agree. They should teach us at high school.
Right.
Start thinking about it then, because you don't. Otherwise, it's largely in the public field that you really start thinking about capital allocation as a real discipline. What's the philosophy at Dover? Is there certain general things that you've seen in terms of the philosophy around capital allocation, of when do you approach inorganic versus focus on organic, doing dividends, stock repurchases?
Yeah, no, we articulate our capital allocation strategy and priorities pretty clearly to our investors. The first is always organic investment, so capital expenditures, R&D. Those tend to be highest confidence, highest certainty investments, right? You're investing right back into your business. You know its economics. You know all the underlying trends pretty well. The execution risk is typically just executing that project well. It doesn't have what M&A brings in terms of culture, the integration risks. So organic reinvestment is number one. Now, the reality is that even though we're an industrial manufacturer, it's a relatively asset-light or capital-light business model. It's assembly manufacturing. It's not, heavy, they call them smokestack production type. And so the reality is you can spend only that much in logical, good organic investment projects. And that's why M&A is our second priority. So after we've funded all logical, good organic opportunities, there is always cash flow left to be deployed. And then your choice is to either redeploy it in M&A or give it back to shareholders, right? I mean, you can't accumulate it indefinitely. And our second priority, M&A, is a productive redeployment of capital. Now, obviously, we will look to do it responsibly and in a disciplined way, investing in a logical way in things that fit our portfolio. And that's where strategic diligence and strategic thinking comes into play. And then if you couldn't spend it organically, didn't find the right M&A in a given year or period of time, then you can give it back to shareholders through dividends and share repurchases.
With organic, I was always curious, like how do you sort of balance between the two? But it sounds like you generally have the surplus. Do the business leaders then present a plan, and this is the capital requirements that they have and that they're looking to execute for the coming year, and then you're sort of investing into that, and then once that's all allocated, you're looking at what's left to invest in the inorganic?
It's not that sort of mechanical, right? But yes, I think every business leader has a view on what kind of organic investments are required to I mean, there's always just maintenance capital. You need to just keep the lights on, keep the assets healthy and functioning, and then there is growth and productivity investments, right, organically. But also every business leader is tasked with having an M&A strategy, right? It's an important long-term driver of value to keeping the business competitive, having a good offering, growing over time, right? Got all the elements of long-term value creation. Now, I will say that I like to use this term, like capital allocation is not a democracy. So not every business gets capital dollars just because it exists in the portfolio, right? And I think that's sometimes a pitfall that people fall into. It's like, well, we have to do deals in a given business, in a given market, just because we are in that market, and that's sort of all we have. You almost need to put your shareholders' lens on and think about, would your shareholders, given the alternatives they have where they can put their money, would they want to keep funding this business, right? So I think one of the foundational elements of strategic diligence, this conviction in deploying capital, is actually being able to articulate why a given business deserves investment. And by the way, it's sort of no hard feelings. You can be a successful value-creating business without M&A, right? If you can be growing organically or improving your returns and margins over time, you'll be plenty busy.
Correct.
Without layering M&A risks and effort on top of that. So I think the concept of capital allocation not being a democracy is very important, and that in my career and even before Dover and consulting, I've seen people not quite follow.
Yes, if it's not a democracy, how would you frame it?
Well, meritocracy, right? I use this word deserve, right? I mean, it may have kind of a negative connotation that someone is undeserving, right? But again,
you don't want to say arbitrary. I don't think that's like it's driven by strategy at the end of the day.
Right. Well, by opportunity, right? Deploying capital is a entrepreneurial risk-taking endeavor, fundamentally, right? You're placing bets. I mean, bets, again, has this gambling connotation, right? But you are never certain about the future, and yet you need to do something, make the move. And you want to see that opportunity and have conviction about it, right? And do it because of that, not because you need to signal to a given business that you're giving them capital, or just following some math of, everybody gets 2% of revenue as a capital to spend.
It all rolls back to discipline on capital allocation.
One of the key skills of the CEO.
Let's talk about strategic diligence. What is it? What does it mean?
Yeah. Look, first of all, there's no bright line between strategic diligence and other diligence, right? I divide it between strategic diligence and confirmatory diligence, right?
Okay.
And by confirmatory, I mean, these are the type of activities you do once you have conviction that this is the right move to make. And then I send an army of accountants, lawyers, tax experts to go check all the boxes, that understand that we're not stepping into some risks, liabilities, right? Understand exactly what we are buying to be ready for integration, right? But there is a layer of work and thinking that happens before you go on that final sprint, right? That is fundamentally about articulating your thesis about that opportunity to place a bet, capital bet, and make good risk-adjusted returns, for whoever that capital comes from. I mean, we typically, all of us in M&A, rarely invest our own money. I mean, there are entrepreneurs for sure, but I think if you think about private equity, family office, corporate CEO, corporate development, we're all investing somebody else's money. And it's the process of building conviction about the opportunity to invest it productively and responsibly before diving into the sort of check the box type final diligence. Deal people, they get a tombstone for just doing a deal, right?
Right.
Which I never celebrate a deal, really. I like to wait a couple of years to see how the thesis played out. I mean, I'll get a tombstone from a bank, but each deal has value creation from each deal has two components, right? It's making a good decision, placing a good strategic bet, right? And that's really what strategic diligence is about. And second is deal execution, right? That's doing the deal right, the right way. Making sure you actually know what exactly you're buying, you're not stepping into some sort of risks. I haven't seen the data, kind of what determines value creation and returns at the end of the day. I personally would speculate that probably 2/3 is driven by the placing the right bets, making the right strategic decisions. And the third is that confirmatory, deal execution frame. If you are placing the wrong bet, the terms of a purchase contract are not going to really save you, right? Now, don't get me wrong. You can execute badly and it can sink the deal, but that execution alone won't make the deal great, right? So it's more of a table stakes. You have to do it right. Now, there are examples where sort of more of an execution, deal structuring is a source of returns, right? And maybe you have a structural multiple arbitrage opportunities, and that's many roll-ups, go buy smaller businesses cheaper and then trade them as a bigger enterprise for a higher multiple. I mean, that's value creation, and I would say it's more sort of execution driven. There is a good example, Warren Buffett, a lot of his greatest deals from the past were these interesting structures with preferred coupon. It's not just a straight equity investment, and it's more opportunistic.
That makes sense in terms of placing the right bet. You want to buy the right company, and I think I'm getting a sense of the strategic diligence part, like the prelim, but really associating with doing diligence against the strategy to make sure you're buying the right company that's going to align with the goals for the company. The execution part, I'm curious about the integration, because this is a big thing that always comes up, is how well you execute the integration. When you think of the other component, placing the right bet, then there's obviously executing to close. But then how about the part about executing the actual integration to see that 2 years out what the final results are?
Yeah, that's a good point. I should probably caveat, if you go back to my sort of two-legged stool of strategic diligence and deal execution, there should be a third leg of, integration and executing on your thesis.
If we were to wait, rebalance the stool.
I'll have to go back and revise my weighting. So it would be half, and then quarter and quarter.
Quarter and quarter. Yeah. Okay. So half, buy the right company. Quarter, nail that confirmatory diligence. Make sure you identify those risks and so forth. And then the other quarter is your ability to maximize value and integrate it, capture on the investment thesis.
Now, reasonable people may disagree with that. And I know if you read sort of literature and articles, a lot of people talk about integration as being that holy grail of value creation. And yes, it's a must. Again, you can have a great thesis and do a deal, and then if you don't execute rigorously on that thesis, well, what good is that thesis, right? So it's another sort of table stakes. But in my mind, it all rests on that bedrock of making the sound decision in the first place that even positions you to execute against something, a good opportunity.
Executing.
Yes.
I agree. And the other variable comes in is how much are you integrating? Like what actually goes into that? Because you could have a huge variable of doing something very transformative to we're just going to wrap some back end things together and let the business operate more autonomously. So when we focus on that, let's talk through the practical how-tos of doing strategic diligence well. Like walk me through somebody, let's say I'm doing my first deal and you want to teach me your thinking so I can not screw it up.
Okay, well, so let's talk about sort of the 5 W's of strategic diligence, what it is, why you do it, who does it, when and how, right? And I think when, you sort of alluded to the when component of this. But let's start with what, right? What it is. And articulating your thesis, how it links to your strategy, what are you betting on, and why your business deserves that investment, going back to our meritocracy, right? And not a democracy concept. Okay, so that all starts there. This is why I want to invest in a given space, and I think it will be productive, value creating, and a reasonably safe investment for the owners of the capital that I'm investing. Good. Then identifying that thesis, there are all, again, going back to the concept of this is a risk-taking entrepreneurial endeavor. Future is uncertain. There will always be uncertainties in your thesis. There will be many of them. Identifying the ones that are least certain and most impactful, and really pressure testing them well, right? And that's in a nutshell what strategic diligence is about. A lot of it is what people would call market diligence or commercial diligence or a combination thereof, but it's not just that. Okay, so second W, why you do it? Well, first, I talked about, well, that's a foundation of making the good business decision. But second, it allows you as a corporate development and M&A professional to look good. As an M&A professional, you will probably find yourself pitching that acquisition to investment committee, to your executive team, to board of directors, I mean, whatever is the decision-making process you are facing, right? So having a crisp, well-articulated, well-supported strategic thesis, why it's a good investment, will make you look good. In addition to making sure you're actually recommending good decisions. Okay, so who does strategic diligence? I would say the key participants would be the business. And the business, I mean, in at least in the corporate context, typically, you are adding to an existing business. Sometimes you are buying a new platform or a private equity context. Okay, so there wouldn't be necessarily a business leader pitching the acquisition, but someone on the investment team will need to wear that hat, right? It will not be necessarily like a deal hat, but more of a formulating a thesis, whether we are doing a roll-up in a given market or we see an opportunity for adoption of new technology. Okay, so there is someone wearing that business hat, and corporate development, M&A professionals, supporting them. And then lastly, you would all often involve some external resources or other functional resources as needed. Okay, when you do it, I would say it starts way before the deal, right? If you're starting to do strategic diligence when a specific SIM pops up in your inbox, it's possible, but it's to still do it, but it's probably too late. It's all grounded in your portfolio strategy and the business strategy. And that's why the engagement with the business, if you're in a corporate role and you're adding to existing businesses, you would want to engage with them pretty closely to understand what they're building, what is the game in their marketplace, right? What is the competitive landscape, where it's moving, what are the investable opportunities and changes happening in the world. And that's why I view that having corporate development and M&A professionals also involved in corporate and business strategy is very synergistic. It makes you a more astute and insightful M&A professional if you understand that underlying business strategy. Okay. Then also way before the deal, I would argue the best practice is what I call this ponds and fish approach about thinking about investment opportunities. And we can elaborate in a moment about what that is. And once you identified good ponds to invest in, good markets, good businesses, then you validate the specific target that either you cultivated or just came onto your radar from the external world. Okay, so we talked about what, why, who, and when. I think the last one would be how to perform strategic diligence well. Okay, so first of all, it's a multidisciplinary, multifunctional endeavor, right? And I can't stress this enough. M&A is one of the most fun and sought after roles, at least in the corporate world, because you have to think about so many, you need to be dangerous enough in so many areas of the business. I mean, obviously tax, accounting, some basic legal concepts are table stakes in M&A, right? You just need to understand that language. But if you are also credible and dangerous enough in operations to be able to talk to operations leaders and validate some of the elements of your thesis, if you understand how the commercial side of the business works, the go-to-market organization, the different models, you can validate that side of your strategic thesis well too. The talent you involve in strategic diligence has to have that ability to operate horizontally. I think there's this analogy, fox and hedgehog, right? And I think foxes are the ones, I can't remember who is the one who's kind of more narrow by deep versus...
I don't know this one.
Yeah, I'll need to look it up. Anyway, you would want to be either a fox or a hedgehog, whoever is sort of expert in a broader set of things. Another animalistic analogy, you want to operate as a hawk, right? And what I mean by that is you want to be able to soar, 30,000 feet. I don't think hawks fly that high, but basically zoom out, understand the landscape in the market, what are the opportunities, what is kind of the grand thesis you're investing behind. But you can't just be there. You can't be at a high level and be credible and rigorous and insightful. You have to be then able to just pivot down to the level of detail. Remember, I talked about identifying those important and uncertain sort of elements of your thesis, being able to really zero in on those and go deep and be rigorous about that. I can give you a couple examples. Someone tells you about customer stickiness, right? Oh, it's a business with customer stickiness, right? And sort of just trust us. But do you truly understand why those customer relationships or your products are so sticky. I mean, the switching cost, right? It's very expensive for your customers. But do you truly understand where is the threshold? And I mean, at some point, the customers will switch, right? Do you understand that how far you can push it? Often it's not switching cost, it's some career risk, right? Nobody wants something to fail. Do you understand how your product, who buys it? How does your product fit into their view of kind of what else they do in their organization, right? How are you helping them be successful? I mean, there's a lot of detail, and you just need to go and talk to those people. And with the expert networks and some of the tools we have, you can and should be doing that, right? Being rigorous. There will be a consulting report that just said the market is growing 5%, and it has grown 5%, and will be growing 5%. Do you truly understand why? And some reports would be more insightful than others, right? But do you truly understand what is the change happening in the world that this product is needed or service at a growth rate above the general economy and GDP, right? Who is adopting this technology? What is changing and why? What is the total kind of available opportunity to you? Market is there are these flow and stock concept in accounting especially. Market is a flow. It's just the amount of goods that trades every year. Do you understand the stock? How many of these kind of products or potential customers are out there? And can you articulate that well? Okay, I'll pause here because
let me make sure I got this. So we're going to go through the W's and the how. The what is basically where you really articulate your investment thesis, and this is where you want to pressure test some of the areas that you want to make sure is valid. Right. And that's first thing you want to start with. The why is building that narrative. This is where you're going to present this to the executive team, the board, and make sure you got that story that helps everybody really understand. And then the who's really driving this, the business, the corp dev strategy team. And then when, this is really interesting because this starts a lot earlier than when you even find this opportunity, that you really understand this market. You're even probably building the relationships with people early on and starting to shape what this opportunities are going to look like. And then the how is definitely multifunctional by nature because you're working with all the different functions in the company. But then you talk through this ability to really zoom in, zoom out, looking at the whole picture, being able to click into these specific details that could be critical in the business success. Does that sound right?
Yeah, exactly. Yeah.
I want to talk more about the pond and fish. Yeah. I like that analogy. It's a good one.
Yeah, not my term, by the way. I heard it at BCG. They use this concept of pond and fish. I mean, the basic premise here is that it's more important to pick the right pond to fish in first. And by pond, that's an analogy to the market or the type of business when you translate it to business and M&A context. Before you start throwing, the line. If you pick a wrong pond, and the wrong pond could be too little fish in it, the wrong kind of fish, not the taste your family likes, and you can be the best fisherman with the best equipment. Think of diligence and execution. Your family will still be hungry. That's why it's so important to pick the right pond first. Okay, so what's the right? And this may sound trivial, but you would be surprised how often I've seen in kind of my career, not at Dover, but even before, people having a bit of a tunnel vision, and I referenced it before, but we will invest in this market because we're already in this market. Not a good argument, right? Okay. Everybody will want to fish in good ponds. And generally people will agree on, what good ponds are. Everybody wants to be in the software business. It's a great business, objectively. So there is some art and skill and luck in identifying these good ponds either earlier than others or having a unique view on what something makes good pond good for you, and that's really the strategic fit, right? So how to go about finding these ponds or markets or businesses to invest in? I mean, first you need to map out the universe of markets and determine how far you are willing to go, right? And that's applicable both in the corporate context and private equity or sort of portfolio investment context. Some may have a strategy. I'm absolutely, omnivorous. Any good business can be in my portfolio. And some would be much more comfortable investing closer to their set of competencies, their core businesses. And there is a separate sort of discussion and work that needs to happen around that. And that will, by the way, be driven by what's the impetus for you to invest sort of outside? Is it just because you have some free cash flow and instead of just giving it back to capital owners, you would rather try to invest it productively? Or are you in a business that's maybe dying and you know it and you need to reposition it and you have a sense of urgency? So there is a lot that would go into that thinking about like what universe would you look at. Okay, and then you evaluate these markets, these ponds, through a lens of strategic attractiveness and fit. And attractiveness, people would generally agree on. It's, growing markets with a credible and understood growth drivers, stable with good margins, good returns, good market structure, well-behaved competition. Nobody is sort of too powerful in that market. The Porter 5 forces and all that, right? Okay, the fit element is a little trickier. It's very straightforward if you invest close to your core. If you go buy competitors, you understand why it fits. That's a business I'm in. I will buy them and take out some cost, and that's a synergy. And I know exactly sort of what business this is. Now, the further out you step out in adjacencies, in that universe of ponds, you will need to start thinking more creatively, but still have conviction about the fit. And here you will often need to start thinking about the business model, right? Like, what is the type of business my team is good at running or investing in? Is it making something small or big? Is it project driven, or am I selling nuts and bolts? Am I going direct to customers or through distributors, or is it online? Is it heavy manufacturing or light assembly? Is it serving a single market or customer segment, or is it sort of global? I'll sell my product to 15 different end markets. You can be successful stepping out pretty far from your core business and find good investment opportunities if you can think rigorously about why is it a good fit, why do I have the right to play or fish in that pond, right? So going through the ponds is understanding the universe I'm comfortable even evaluating and going after, and then systematically evaluating with the attractiveness and fit. And best-in-class companies would have actually very precise, almost quantitative way of going about that, right? It's not just kind of intuitive feeling, right? All of these elements of attractiveness, I mean, obviously growth, returns, I mean, all of those things are quantified, but things like balance of power in the market, and elements of fit, each portfolio, each company needs to articulate for themselves, like what fits you. And that may differentiate you in that, hunt for good ponds, right? Because like, again, everybody will recognize attractive ponds, but not all of them will fit everybody. That's how you can.
Yeah, I like that view because it doesn't get talked about much. Is these deals get harder to do the further you go away from your core, but you have this view of really understanding your strengths that you're going to be able to leverage despite going further away from your core. What is that you're going to be able to have that advantage around?
Right. Recognizing that you'll be taking more risk, right? I mean, you go read some of these studies by consultants and they will always say that obviously probably the bigger deals and further out from the core, more risk, right?
I agree. And then how do you counter that with your strength? Do you have examples of like what would be specific strengths that you could leverage even despite going further away from your core? Because I'm imagining customers could be different. Maybe it's business models sort of fundamentally similar, and that could be a strength. But I don't know if you had other examples of what would be strengths you'd latch on to.
Well, strength, you can describe them either, if I'm a business, things I have, assets that I can leverage better by adding M&A to it, or things I'm good at, I can do well. And they are slightly different, right? Like assets versus capabilities.
So if we're like incredibly good at marketing,
right?
That even though we're going further away from our core, we may still look at it and saying, hey, this is a strength we can still leverage. We can bring our marketing competency to this company.
Well, I'll give you an example. I think it's well known in the business world and kind of relatively dated, but I don't remember the name of the brand, but this Arm & Hammer, like consumer goods.
Yep.
And I think the company at some point realized, hey, we have this basic. I think they had a much, much narrower portfolio of products. And now you'll find that on soda and a ton of consumer products. And the thing they had was, well, we have this channel to big retailers and shelf space and some brand recognition. How can we add to it, right? Like once I'm sending a truck to Walmart, what else can I put on it? Right? Okay. You can productively exploit that through M&A, right? Like that's an asset. I have something. What can I add to it that wouldn't necessarily be obvious, right? If you didn't think about it that way, right?
Toothpaste.
Right. Well, and then you can keep sort of building it out. Yeah. That's leveraging your assets, what I have. Capabilities, it's more what I talked about, like what am I good at, right? And that's where you can invest behind businesses that they look similar. It's not the same customers. I can't leverage my distribution channel. I can't make it in my plant. My salespeople can't sell it, right? So it's completely unrelated. I can't leverage any of my assets, but I know how to run that type of business, right? If the product is something that, let's say, sells for $1,000 a unit and it's a little widget and it goes through distribution and it's light electronic assembly, okay, you can, and I'm good at running that type of business, doing the sales and operational planning, optimizing the supply chain for it, that assembly, optimizing distributor management, doing some of the R&D in that space. Okay, I can go and invest behind businesses that look like that have nothing in common in terms of, customer segments, specific customers, specific channels, production facilities. Make sense?
Yes. Can we make up an example to go through the strategic diligence exercise? I don't know if you want to pick your industry. I can pick one for mine. I can pick one for mine. I don't want to get you in trouble.
Okay.
So we have our deal room products, our main business, which is like M&A lifecycle management, but we have this spin-off data room product called Firm Room. I have a hypothesis that is a pond, which is pretty fragmented and pretty ripe for consolidation.
Mm-hmm.
And our product, because it's a spin-off, operates at a really high margin. So we can essentially acquire something in that pond. So that's like a pretty straightforward, right? And I'm just using this as a general example. We'll expand from here. One, how do you look at this pond and right away there's sort of a good sense because I'm doing the one we're playing away and then we can make up one away from the core. When I start thinking about the size of this overall pond, right? Because we say this is about data room markets, about $1.5 billion market cap. When you start looking at it in the fragmentation, I know there's 3 companies that have maybe about 70%, 75% market share. And then the rest is like fragmented with a bunch of little companies. When you start looking at that, like, does that give you any indicators or do you start putting consideration around that in terms of how diversified how many fish are in there and how big they are?
One of the elements of actionability. Okay, so maybe there needs to be a third element of a pond assessment: strategic attractiveness, fit, and can I do something with it? Because sometimes you will see pond, yeah, it's a great business. It's a duopoly, and none of those are available. So like it's not investable because it's not actionable. So finding out the number of fish in the pond and the actionability, right? Like what is the reason to believe I can actually go and buy some of them should be that third element. And how they say, like one deal is not a strategy. Just saying like, oh, that's the market and I can go buy this target to enter that market. Okay, I mean, it's very binary, like it will happen or not.
Right.
It's not a strategy. If you are convinced I want to invest in a given market, well, you better make sure there are like 3, 4, 5, 6 targets and hopefully you get 1 or 2. Now, if there are 15, yeah, your thesis can be, well, I'll go and roll up 7 of them.
I think it would have to be in that direction. You would have to look and say, okay, there's probably 100 different companies out there.
Right.
3 of them control 70% of the market. Could we string together 10 of them and start getting towards like 15% market share? Then it's more of a roll-up play. We're trying to arbitrage a multiplier.
Yeah, I think you would need to think about, if there is already like 3 market leaders and you're rolling up some sort of long tail, so is the thesis that you are creating a scale competitor that will be able to take some market share from the leaders or not?
This isn't that sexy. Let's find a different one. Let's go out of our core. Obviously we got AI's hot. I see a bunch of data companies popping up. I'm sure you're getting a lot of calls from folks that want to sell you data to go find targets. And I don't know, there's integration software, but that gets a little murky. But if we were to say, further away from the core would be maybe if we went for our services, right? And that's further away from the core. If we got into BCG type of business, M&A consulting.
Yeah, well, I mean, I think you're leaping over probably. So if you think about the core is just data room as a segment, right? There is other M&A related software. I mean, there is deal pipeline management. That's not data room, right?
Yep.
There are other tools, but they're still within M&A, right? So like you would be leveraging your channel. Hey, I know corporate development professionals. I can sell them, and like, can I add, more things in my
Okay, so we're not going to jump
bag.
Too far from the core. Stay in the software domain.
Well, but even before going to software, like, okay, there is M&A software, and there is other business software, right? So maybe a vector could be, okay, so I have data room and I can expand in other M&A software. or I can leap and say, hey, I'm good at selling professional, workflow automation software to highly professional users in corporate America. Okay, that's a capability. There's other software that's not M&A related that fits that, right? And maybe you can find. Now, many of those markets are kind of mature, right? But maybe you find a niche that's more emerging. It's AI-powered tools, right? And I would argue after that, you would leap into more of a service, right? And you can also think about, well, I can provide more services around M&A than just deal room. I can advise on M&A. You can be creative.
I like where you're going with this.
Yeah.
Well, I want to, let's pick one because I want to get to the other steps of how do you actually kind of form. We build our hypothesis and we want to create our investment thesis on, let's do, if we did, say with aerospace defense government, right?
Mm-hmm.
That's like its own sector. And if they look at project management type of tools, those are like super outdated and pretty enterprisey. But that's definitely an area we want to get into because you pretty much need to get FedRAMP certified to really play in that space. And that's a big blocker for us. Like we don't have that capability, but we do have a lot of that, the workflow examples and stuff like that. So we start mapping that out, and this looks like a nice, away from the core, but we see some of these strengths that we have that we can bring some of the modern, now we're building AI and bring it to this old, pretty slow moving industry here. So if we start building that, next thing is just kind of pressure test. Like what are those things, how would that actually fit in? Is there any like thinking that you would start with in terms of pressure testing that investment thesis?
Well, I mean, I guess, so you found a good pond, right? And then I think the question should be, is it possible to pursue it organically, or is inorganic as a way to enter, right? Because when you say, well, licensing and all these barriers to entry, well, okay, go buy someone and that gives you a foothold. Yeah. And you can build from there. What you're saying is, well, it's probably hard to enter it organically, but that's why inorganic may be the answer. Now, on the organic front, and again, depending on what kind of sort of capital you're willing to put at play to pursue a market, right? Some of these high barriers to entry markets, at the end of the day, they can still be entered, right? If you're persistent and you're willing, again, to place that bet of enough capital. I mean, there are examples in aerospace and defense. The company you may have heard, Anduril. I think it was founded by a person who sold Oculus, virtual reality, to Facebook, to Meta.
Yeah.
And I think he went on and founded this basically defense contractor, which was, considered a very small club industry, Lockheed and some of these primes. And with sort of enough insight in what's needed, capital to put at work, persistence and enthusiasm, I think they're making big strides. So
be open-minded. That there may be a way, or in this example, like partnering with a reseller could be an avenue to get into the industry.
Right.
But we found something. We found the pond, and maybe we are so you're right. There's sort of, those are good areas to pressure test. And then if we get past that and saying, hey, this seems like the opportunities are valued pretty reasonable, especially if we find a business that's pretty stagnant with the growth, that we could acquire them and expedite getting into this industry. Then what? Am I ready to build my pitch?
Well, I mean, I think we talked more about ponds. There's evaluating the fish, right? That's where the deals start hitting your inbox.
So now my investment thesis got to target a specific fish.
Right. So ideally now you have a good thesis. You know where to fish. And ideally you would have multiple ponds. I mean, again, depending on maybe you're a little fund that's just rolling up, I don't know, dental clinics, right? Like that's your pond, and then your ponds could be different regions of the US, right? Now, if you're in some bigger portfolio, you'd be hopefully working with multiple ponds, and then fish will start sort of hitting your radar, and you will need to be evaluating. And again, there is a strategic element to evaluation of targets before the confirmatory diligence. Things like market share, the competitiveness of the products. Why do truly customers buy that product over the other product? Analyzing wins and losses. Why do they win and why do they lose? Do you truly understand that, right? So going back to some of this, it has to be rigorous. You have to be able to pivot and not just sort of accept, oh, they're gaining market share, it's growing, this hand wavy.
Yes. Well, so it goes back to, on the why part, it's answering the why this pond, why this fish.
Right.
And then you're basically doing like a SWOT on both of those.
Right.
And then who? We're a little company, so it's mostly me. Well, 50 people. 50 people, so I'd pull a few other leaders in place, probably our COO and maybe a few other leads. And then, so identifying who's involved in the team. The when is an interesting one that ties back to doing this research and really spending the time to know this market so that we are identifying the right company and making sure stars are aligned to go execute it at the right time.
Look, I mean, you're constantly maybe you can go through maybe you were in a sleepy company that was in a given business, didn't really think about deploying capital productively or didn't have capital to deploy. Mm-hmm. Okay, and then maybe the company woke up, realized we need to do something, right, to be great. And you go through an exercise and you find ponds and, you want to be more aggressive. That's more of a one-off exercise. But then you do need to maintain and constantly update your views, right? I mean, it's a dynamic world and it's changing faster than ever. One market is red hot 1 year, and the next year it's not, right? You kind of need to stay up to date on all the ponds, both that you've chosen to keep validating the thesis. Yes, it's still investable, but also maybe some of the ones you've written off, deprioritized, well, maybe they are becoming more investable over time. So it's an ongoing iterative activity.
So, one of the things that we didn't talk about is in terms of sourcing these opportunities.
Okay.
Do you proactively source these opportunities with building your own pipeline and finding what's available in the market? Or do you network with the bankers and get on their radar for them to bring you deals?
Well, it's both at the end of the day, right? I don't think you can rely just on one approach. If you follow kind of the process I laid out, with sort of identifying the ponds, validating that there is fish there, you would know what that fish is, right? And so constantly having a long list or short list of both ponds and fishes, targets in that pond, and trying to cultivate it, that would be the best practice. And that's a way to cultivate what people call proprietary opportunities, right? Before they become auctions and highly competitive. But you do need that network. You do need a flow, especially if you hunt in this middle market, lower middle market. And that's where like most of the deals we do here, kind of middle market, you will probably not know, 100% of the targets that are available there. And sometimes, you will see a target that's in a pond you just didn't think about. And then once you see it and you go through your sort of thought process, well, is it attractive? Does it fit? And you realize, yeah, right? And why? Well, because that process of laying out what ponds are I should be looking at. I mean, it's kind of creative. I mean, you can say, well, the whole economy, the whole universe, I can go invest. But people usually don't do that. They kind of draw a line somewhere reasonably not too far from the business they are in. And you can miss interesting markets and ponds, and it's okay, right? Again, it's an iterative process. And then you learn about that pond, but sometimes just through getting an inbound target.
I agree. That's like a really good way to learn an industry, is to see what's being marketed and study it.
And then you can be more proactive. You can learn about an industry, sort of reacting to it, but then you can get more proactive.
Yeah, with that knowledge, absolutely. When does culture come into the picture? It comes up a lot when I do these interviews, but as I'm going through this exercise of strategic diligence, culture anywhere there, or does this stuff happen after we sign?
I would say it's an element of fit. Probably not so much about the pond, the market, as it is about a specific target, right?
So I'm down.
I mean, you can argue some markets have kind of, it's something like to be doing business in a given industry, right? Some industries have reputation, and you can think about like, is that the kind of culture I want to be?
Okay.
And then, by the way, that could be like ethical risk, and some industries are just more prone to it, right?
Fair enough. When we look at building this investment thesis for the specific fish, does that culture does this come up to the story I'm presenting to the board of why they think they're such a good culture fit for us, or is that too early?
Yes, I would argue it should be, right? If you identify yourself as a, let's say, engineering-driven, R&D-driven, technological company, and that you want to see that similar culture in the target you acquire. Yes, so for sure. And by the way, in diligence and negotiations, it certainly should be an element of evaluating that culture when you interact with the leadership, with the management of the company, right? Can you pick up the signals, the data points about what kind of culture they adhere to, how they negotiate with you? I mean, there is a signal of culture, especially if you plan to retain the sellers as management for your business. How they behave in negotiations, how they treat, how they approach it is very much signal of culture in the business.
You ever had that where they're such a pain in the ass just negotiating the NDA? You just said, forget about this.
Yes, there are more painful processes. Yes.
So, but you get early signs just from that. Like, hey,
right. Well, I've had once. I saw a seller of a smaller business, and you see a lot of sort of quirky things when buying businesses from private sellers and entrepreneurs. And I have immense respect for all of them. I mean, these are people who built businesses. Sometimes they acquired them, sometimes they inherited them, but they made them generally stronger or maintained them. M&A is not what they do, and so they would have some interesting ideas about how to do M&A. And once I remember there was a seller who was thinking about selling a company. I was like selling a house and wanted an earnest money, like a deposit, that we're serious, and have some sort of like standard pre-negotiated contract before allowing even the diligence.
oh wow,
Yeah. So yeah, people get pretty creative.
yeah,
in this.
that's a fair point. You get a sense of culture from how we're going to do the deal. Integration part, like, how do you start thinking through integration?
It varies obviously by organization.
I almost probably should have framed it more as when do you start thinking about integration?
Look, I mean, early on, right? By the way, I would say if you go back all the way to does the business deserve investment? An element of that is, well, can they integrate and execute? whoever they are, that team you will be entrusting, right?
This is before conversations with the team or early conversations.
Well, I mean, your business team. So if you're in the
Okay.
corporate context, I mean, that's a little different in let's say, private equity context, right? But yeah, if you're in a corporate environment and you are, adding a business to your existing business, thinking about the team I have, can they integrate? Can they execute on that thesis?
Who would you rely on for that insight? Whether it's the business unit leader or is it here's a designated integration function, which I'm assuming you have.
I mean, generally, let's say that's a role of senior management.
Okay.
CEO level.
And so they would have a sense in
segment or even corporate management. Yeah, it's.
And you'd want to get their pulse of, hey, we're looking at bringing fish in to our company here. Do we have the capability or capacity to do it?
Very much so, yeah.
And then you get some validation, like, yes, go ahead. But then there's not like too much clicking in and trying to build like a real detailed plan. There's more of going back to the assessment. If there's a real strong strategic fit, building out this investment thesis to get an actual approval to do the deal.
Well, ideally, you would have a blueprint very early on, right? Again, even before you start this final confirmatory expensive diligence phase, while you're still formulating your thesis in a strategic diligence phase, you do need to have a blueprint of how I'm going to run this, how I'm going to integrate it, and some of the main opportunities, risks, and decisions involved in that. And then obviously you flesh it out as you go through in more and more detail.
So you had a blueprint before LOI. Hey, this is a rough idea of how we're going to integrate this.
Look, and by blueprint, I mean, it can be in somebody's head, but whoever will be responsible for delivering needs to be able to convincingly say, okay, and I have kind of general idea how we can run it and how it fits into our existing organization.
I feel like this thinking gets along the big red light. This thinking gets along the lines of the big red flag items that you would start looking for early in the deal. And obviously, like a big integration risk would be one of them. What are other big red flag items that you're looking for in this strategic diligence phase?
I mean, big hockey stick projections.
That's every bank deal.
Yeah, well, yes, there's still a spectrum there, right? And how it's articulated, there's also a spectrum from complete hand waving, just trust us, to at least some attempt to, may have a driver tree, like, okay, this 7%, 10%, 20% growth rate will be driven by this, and this, right? So there's a spectrum there. From evaluating the business standpoint, like big wins and losses, customer wins and losses, understanding why they're happening, right? If it's wins, it will help you understand why they're strong, why they are winning. If they lost customers, you really need to make sure, it's not some sort of obsolete technology or there is an emerging competitor coming up, right? So you really need to think about that. Market share gain projections, you would often see same, just, that's a market growth rate and then a couple percentage points for market share gain. And you really need to pressure test why, right? And especially if it's happening over the long terms, I mean, it's a finite strategy to gain share. You need to be thinking about, well, what will competitive response be to your continued attempts to gain share from them? So it's all of those are
market strategy, customer base. What about the people? How do you know these people are going to be good long-term investments versus you're going to have to invest in changing some things?
Well, I mean, it's that's highly situation dependent. Sometimes you are more reliant on people that you are sort of bringing over versus less, right? I mean, sometimes, again, the closer to core you invest, the more comfortable you are that, look, I'll figure out how to run this business. Now, you do need to understand, especially maybe in less sophisticated, smaller, less mature businesses, there could be, these key man risks, some repository of knowledge that's not sort of documented, codified, but is very important. And identifying those people in diligence and thinking about their retention, obviously, is a big element of any good M&A process.
I don't know if anybody listening to this is getting convinced M&A is like really easy to do, but there's so many variables here to unpack. I got a few questions so before we wrap up, because I know we're already past time here. What's the biggest challenge when performing strategic diligence?
I like to tell people on my team, you have to have a almost quantum mindset. You have to be both the biggest proponent of the deal and the biggest skeptic of the deal at the same time, and not have cognitive dissonance because of that, right? And that will change depending on the audience. When working with diligence teams, driving diligence, strategic and confirmatory, you kind of want to be a skeptic. You don't want to take things for granted or just trust. You want to pressure test, validate. I mean, again, be thoughtful about things that kind of matter. Now, but at the same time, as a person who helps decision makers deploy capital, build better businesses, get the deal through approval processes, whatever they are, investment committee, executive boards. You want to be the proponent. You want to use the learnings and being a skeptic to steel man your thesis and be a good proponent of the deal. And that's not trivial. I mean, people kind of like the deal or not, and they may just default into one or the other mode. And I think there's some art in trying to keep both.
That's a really good, because one, if it's not a good opportunity, you'll eliminate it quicker. And two, it's very defensible when you're presenting this opportunity to leadership.
Right.
Andrey, thank you so much for the time today. I enjoyed this conversation. You helped me become a better M&A scientist.
All right. Sounds good. I enjoyed it too. Thanks for coming.
Those of you still with us, thank you for sticking through. Till next time, here's to the deal.